You open up a chart, green candles, red candles, volume bars, indicators. But you have no idea where to start. Should you buy or sell? Where do you enter? Where do you put your stop loss? The more you look, the more confused you get. The problem isn't that you lack knowledge. The problem is you don't have a process. Today I want to share the method I use every single day. It's called top-down analysis. You start with the big picture, then zoom in step by step. Each time frame answers one specific question. And to keep this practical, not just theory, I'll walk you through a real trade I took recently, from start to finish. All right, let's start with the daily chart. The first thing I always do is open the daily chart. Not to find an entry, but to understand where price is right now. Looking at the big picture, BTC dropped from around 126,000 all the way down to about 68 to 69,000, almost cut in half. The long-term trend is clearly bearish. A lot of people see that and immediately think, bearish, just short it. But the daily chart isn't really there to give you that answer. What I actually want to know on the daily is, does this current price zone mean anything? And the 60 to 75,000 zone is not random. If you scroll back on the chart, this is the exact area where BTC consolidated for months back in 2024, before it exploded up to 126,000. When price comes back to a zone where a lot of trading activity happened before, that zone tends to react. Simply because a lot of traders remember this level and a lot of old positions are still sitting here. And in fact, back in February, price dumped hard, all the way down to 59,000, but then bounced right back up to 75,000. That bounce tells you there's real buying pressure in this zone. And since then, price has been stuck in the 60 to 75,000 range for over a month. That tells you buyers and sellers are genuinely fighting it out here. So from the daily chart, I take away three things. One, the overall trend is still bearish, so I'm not expecting a trade to run far. I'm only looking for a short-term bounce. Two, but price is sitting at a major support zone, one that already had a strong reaction before. Three, if I get a setup, I'll look for a short-term long, reasonable target, no greed. All right, big picture is clear. Now let's zoom into the 4-hour chart and see what's happening more recently. After that massive dump in February, price bounced and has been trading in a range, roughly 62,000 to 75,000. Going up, coming back down, but never breaking out. On the daily, we already know this is a major support zone. Now on the 4-hour, I want to figure out, within this range, which areas matter most. First, I look at the resistance zones above, areas where price gets pushed back down. The closest one is around 71 to 72,000. After price dumped from 75,000, it bounced back up into this zone and got pushed right back down. So this becomes short-term resistance. Further up, 75 to 76,000 in the top of the entire range. In early March, price rallied up here and got rejected hard. This is the strongest resistance in the range. Next, I look at the support zones below, areas where price tends to bounce. The closest one is around 67.5 to 68.5 thousand. This zone is special because before the rally to 75,000, price was consolidating right here. When price breaks out of a zone and then comes back to test it, that zone often becomes support because the buyers who entered there still want to defend their positions. Further down, 65 to 66,000. These are the swing lows from early March, a deeper support level within the range, and the furthest, 59,000, the February sell-off low, just for reference. I don't expect price to go back there. Okay, zones are mapped out. Now let's look at the most recent price action. In early March, price rallied hard from around 66,000 up to 75,000, hitting that major resistance. Then it got rejected. Price started dropping 75,000, then 72,000, then 69,000. And now it's sitting right at the 67.5 to 68.5 thousand demand zone I just talked about. But here's an important detail. Look at the volume. As price has been dropping, volume has been decreasing too. That means even though price is going down, the selling pressure is getting weaker. The sellers are running out of steam. Price is at the old breakout zone, and the selling is drying up. This is a key area. I need to watch closely whether buyers step back in to defend it. And this is what I notice the most recent candles. Look closely. 2 candles in a row, both with very long lower wicks. Small bodies closing near the top. What does a long lower wick mean? During that session, price got pushed down, but before the candle closed, buyers pushed it back up. 1 candle could be random, but 2 consecutive candles wicking at the same zone, that's a clear signal. Buyers are present at this demand zone. So on the 4-hour, here's what I see. Price is sitting right at the 67.5 to 68.5K demand zone, and those rejection candles tell me buyers are reacting. But I'm not rushing to enter. I need to look closer. Inside those rejection candles, what's actually happening? Let's switch to the 1-hour chart. Now let's switch to the 1-hour chart. From the 4-hour, we already identified the 2 most important zones, supply at 71 to 72,000 above, and demand at 67.5 to 68.5 thousand below. On the 1-hour, the picture becomes clearer. Price is trapped between these 2 zones. It bounced up into supply, got rejected, and dropped back down. And now it's diving straight into the demand zone. The question is, are buyers showing up here? And the answer is right on the chart. Look at the most recent candles. Price keeps getting pushed below 68,000, but every time, it bounces right back up. Long lower wicks, small bodies closing near the top. This isn't just 1 candle. This is a whole cluster. Multiple candles in a row, all wicking at the same price zone. Sellers keep trying to push price down, but around 67,700, it gets bought right back up. The demand here is real. Buyers are defending this zone aggressively. The signal looks pretty good. Buyers are clearly present. So why not just enter the trade right here? Simple reason. If I enter on a 1-hour candle, my stop loss has to go way below the wick, below 67,700. The distance from entry to stop loss is too large. Too much risk. The 1-hour tells me I'm at the right zone with the right side. Buyers are fighting at demand. But to find the best possible entry with the tightest stop loss, I need to look closer. So I'm switching to the 15-minute chart, watching every candle, waiting for the right moment, and looking for the cleanest entry I can find. 15 minutes. This is where I look for my entry. From the 4-hour, I already have supply at 71,000 above and demand around 67.5 thousand below. But on the 15-minute, I also spot 2 additional short-term supply zones. 68.8 to 69,000 and 69.3 to 69.6 thousand, levels where price bounced up and got sold off. So the map is clear. Supply above, demand below. Now I wait and see how price reacts. And then price starts moving. It rallies up, hits the 68.8 thousand supply zone, and gets pushed right back down. Price drops straight into demand. But look at that last candle. A long lower wick, touching demand and bouncing hard. This is the signal I've been waiting for. Sellers pushed price down, but buyers aren't giving up. They buy it right back up at demand. I take the trade. Entry, around 67,820, right after the bounce from demand. Stop loss, below 67,200, below the demand zone. If price drops below that, the setup is wrong, and I take the loss. Targets? The supply zones above, 69,000, 69.5 thousand, and the furthest one at 71,000. Risk is about $600. Reward if it hits the final target, over 3,000. That's roughly 1 to 5 R to R. Now let's see how price moves. After entry, price runs up quickly, pushing to around 68,500. Good. But then it comes back to fill the FVG, the price gap it just created. The candle wicks down into the FVG zone, and the very next candle, buying pressure comes right back. This is the signal I need to move my stop loss to entry, meaning this trade is now risk-free. Worst case, I break even. Price continues bouncing from the FVG. But then there's a small pullback. Price hesitates a little. But look closely, this pullback is weak. No big red candles, no real selling pressure. Sellers are clearly running out of steam. So I keep holding. And then price accelerates. One big green candle pushes straight up into the 71,000 supply zone. This is my target. Right at supply, I see sellers jumping in. A wick appears at the top. Price starts getting rejected. I close the trade. Plan complete. Not because I'm good at predicting, but because I waited for the right moment, had a clear plan, and managed the trade step by step. When every time frame tells the same story, yet you just need enough patience to listen. So the entire process comes down to 4 questions. Daily, where is the market? 4-hour, which zones matter? 1 hour, who's winning? 15 minutes, where do I enter? No magic indicators, no secret formula. Just 4 questions, and the patience to wait for the chart to answer them. Anyone can do this, but not everyone has the discipline to wait. If you found this analysis helpful, subscribe. I'll keep sharing case studies like this one.